Good morning. Eric, I think, did quite a good introduction of a lot of the topics that I wanted to cover. I mentioned yesterday that I was fairly nervous standing in front of a group of regulators as an ex-CFO. I'm even more nervous when the EU Commission is sitting in the audience, and even perhaps more so when I'm talking about the specific topic here, which is the difference in perspective of a CFO versus a regulator. Like Eric, if you want to stop me at any point and ask any questions, feel free to. We did touch on this topic a little bit when Philippe and I were up here talking yesterday, so I think we've covered some of the points. So I'm going to go through the presentation fairly quickly to try and cover the main issues that I wanted to touch on, and then maybe we'll leave some questions for the end, or some time for the end, if there are any sort of roundup questions for Eric and I that we can discuss at that point. Just in terms of what you've got in your pack, there are about 14 or 15 slides that I'm actually going to talk to, and then there's an appendix of about 20 or 30 slides that go through the main differences that I have identified during the course of actually being an accountant, dealing with IFRS and also dealing with regulators. And that appendix is something that you can kind of refer to later, and it'll give you a little bit of additional information. It lists all the various issues that I think are different and why the differences exist there. So I think as we've covered, and to an extent as Eric pointed out in his presentation, IFRS is a useful starting point. It's a useful point at which you begin the process of understanding what's happening with a financial entity. From a regulatory perspective, there are different requirements, and if you're going to use IFRS as a starting point, or for that matter, if you're going to use national GAAPs as a starting point, it's very important that you understand the differences between what the objective is of IFRS and the objective is of national GAAP, or of the regulatory environment. You have a number of tools that you can use to adjust numbers, and I think Eric covered a lot of them. It terrifies me a little bit. There's a book that's trying to compete with the IFRS book for size, but at least you've got the starting point in that book, or you've got the tools in that book that allow you to make these adjustments. And as we talk a little bit over the process of the next couple of points, I'll try and mention some of the adjustments that I've seen that seem to work particularly well in practice. So to cover again, and we did discuss this a little bit yesterday, but I'm going to sort of re-emphasize it. The objective of financial reporting is to provide information for effective resource allocation. Now that's a little bit of a motherhood and apple pie type statement. It's a statement that kind of works whichever way you look at it, but it finds itself in terms of the way that we actually interpret the standards as we go through the process of standards. So we want financial statements to reflect the effect of market events. If market events are volatile, we want financial statements to be volatile, because we want the volatility that is inherent in the business to be reflected in those financial statements. We want financial statements to be transparent. We want people to be able to see exactly what's happening in the underlying company and have as much information about that underlying company as possible. And we want to make sure that capital utilization is efficient. Now, when I'm talking about this from the perspective of a CFO, what this meant, that the task that I set out when I looked at my accounts, was to try to limit the volatility by limiting the type of economic activities I went into, not by trying to change the accounting. I wanted to try to make sure that the only things that I did in my business, I was comfortable for the market to see. In other words, I knew the transparency was there, so I needed to make sure I wasn't engaging in activities that I would feel embarrassed to talk about. Okay? And efficient capital utilization meant I wanted to minimize the capital I was using in my company. I wanted to keep that capital as low as possible. Now, all three of the first points, I think, are points that are common both between regulators and preparers of financial statements. We all want those things. Sometimes IFRS is not good, and one of the things that we're trying to make IFRS better at is the whole transparency issue, to shine the light on accounts issues. But sometimes the reason we get it wrong in IFRS is because we have too much disclosure. If you give me a 400-page book, I can find somewhere in that 400-page set of financial statements to hide something embarrassing. I can stick it away on page 376. And we always used to joke at First Rand when we prepared our financial statements that on the third last page of our financial statements we wanted to put a sentence in that said, if you're still reading at this point, phone this number and we'll take you out to lunch. And we figured it was a pretty safe bet to put that in there, because that is the problem. Sometimes transparency means less disclosure, not more disclosure. Because too much disclosure means people sometimes miss the important things, and it means we can hide the important things if we wanted to. Regulatory approach has got a different objective. Its primary objective is the stability of the sector. Now we start out and we talk about, and if I pick on a couple of the things that Eric mentioned when in his presentation, Eric talked about things like unrealized profit and losses. Unrealized profit and losses from the perspective of accounting, if I have unrealized profit and losses, all it means is that on the very last day of the year, I didn't choose to sell something and buy it back immediately. Because that's how I could realize the profit. I just sell it, 20 minutes later I buy it, and I've now realized the profit, but I haven't changed my risk exposure. So from an accounting perspective, an unrealized profit and loss is simply something waiting to be realized. It's simply something that's available to be realized. So if I want to represent where I am on the economic cycle and how cleverly I'm managing that economic cycle, I need to see that economic representation. But fundamentally, that doesn't promote stability. And it doesn't promote stability because it makes me look much better in good times, and it makes me look much worse in bad times. And the problem with particularly banking, insurance might also fit into this space, but in particular banking is a confidence business. What I sell when I'm a bank manager, what I sell when I'm an owner of a bank, is I'm selling trust. People need to trust me as a banker. And they will only trust me if they see that I'm performing within parameters they think are reasonable. If my results become too volatile, if my results go up and down, it doesn't matter if I've got lots of capital. It doesn't matter if I'm looking particularly safe. If people think I'm in trouble, people will withdraw their money, and then it doesn't matter how successful a banker I am. I've lost the trust. I've lost my primary inventory, the primary thing that managed me as a banker. So by losing trust, I've probably gone out of business. Your job is to help you actually helping me as a CFO in securing that trust. And the way that you're doing it is to prove to the world that there is a regulatory environment behind that is making sure I have enough capital. But one of the things that you have, one of the tasks that you have with that is to try to limit volatility of earnings. One of the things that I'm trying to do as an accountant is reflect volatility of earnings. So we have a little bit of a conflict in terms of the way we think about those things. So stability of earnings and balance sheet are a critical thing from a regulatory perspective. Controlled release of information. So there are times when information released into the market can have an effect on the market. And precisely the point I made about the concern that if I suddenly show a big loss, people lose trust in me. So controlled release is more important than transparency, potentially from the perspective of a regulator. And reserving in good times, and I think Eric talked about that specifically, and about the way that we try to do provisions for bad debts. Something like a general provision, and in the context of First Rand, in the olden days before we got to IFRS, we had a general provision of 2.5%. So we would put 2.5% away of our book every year into our provisions. We call that a provision. The problem with something like that reserving in good times, is you have to be careful how you do it. Because what that meant from the perspective of our company, First Rand, is when the bad times came, we had a choice. We either changed our policy and said we're not providing 2.5% of bad debts anymore, now we're going to provide 1%, and that would release something into our income statement. But then the whole world would say, well, why are you changing your policy? This looks like it's now bad times. It looks to me like you should be more conservative, not less conservative. Or we didn't do anything, which meant that the 2.5% just stayed in reserves. And I think that was your question at the back there. Part of the problem with the general provision is you create it in good times, but you can't use it in bad times. You put away a rainy day fund, and then when it's pouring outside, you can't touch your rainy day fund. So this is one of the risks that you have to take into account in thinking about things like a general provision. Conservative capital policies are also important. So having some sort of conservatism in the capital policies, retaining capital over a period of time. I remember what I said, that the objective of a CFO is to try and efficiently use capital, to have as little capital as possible. The objective of a regulator is to have as much capital as possible. So you've got these two sort of conflicting things, if you like, in place here. The important thing for me, though, is that as much as they feel like conflicting things, as much as they feel like things that are fighting against each other, there's actually an awful lot of common ground here. As a CFO, it was important to me, as a CFO who was out there selling trust, who had trust as the main thing, that part of my bank, Stability of earnings was just as important for me. And I needed to think about the type of products I entered into when I actually entered into products in order to ensure stability, in order to retain stability. South Africa went through the 2008 crisis, and rather than going from profits to losses, we went from profit of 100 to a profit of 75. It was still pretty devastating for us. It was still pretty horrible for us that we went through that. But it was only a reduction in profits, and we didn't have the same sort of confidence attack, if you like, on our books as a result of the changes in the economics in 2008. Why? Well, it wasn't anything clever I did. It was my regulator trying to help me achieve stability of earnings by actually not allowing me to enter into some products in the first place. So CDO products, securitizing mortgages and things like that, we just were stopped from doing. So nothing changed in the economics. The economics between the accounting and the economics between the regulatory were the same. But there were simply some product types that we weren't allowed to do, or that the regulator, to go to the last point, the regulator made so expensive for us from a capital perspective that it just didn't make sense for us to do it. It was made so incredibly difficult, that we couldn't actually recover sufficient money to get a return on capital. It brought in a conservative capital policy, which then conflicted with my capital utilization policy, and the combination of those two meant that I was in a situation where I just didn't bother doing the products because they didn't make sense. So there are different ways that we can get to the same type of argument. The Basel II one-year EL is a calculation of a conservative reserving policy. Eric mentioned when he discussed about the downturn LGD, the through-the-cycle PD, but a stressed P, if you find that your actual PD is lower than the through-the-cycle, you use the lower one. That's a conservative reserving policy that makes sure I have sufficient capital to sustain losses. And then maybe the most important thing of these 2 points here is the perception thing. What assists me as a banker from a regulatory perspective is if I am seen to have good regulators, if the market understands that my regulators are good and on the ball, if the market understands that my regulators are making sure I reserve in good times, I reserve capital in good times, and I have conservative capital policies from my regulatory environment, what that assists the market in doing is build the trust. So these things done by the regulators actually help me from an accounting perspective in building the trust with my user base. It doesn't stop me reporting my accounts as my accounts should be, but it helps in me selling the idea that I have trust. And I think when you're out talking to bankers and when you're hearing bankers say, this is not fair, why are you making me do this, you're too conservative, this is a part of the argument that needs to come into the process. Part of the argument is that you helping build that thing that I need in order to do my business properly. So a couple of differences in approach that come out of the consequences of those things. The first one is IFRS tries to always reflect a point in time. We're always worried about where we are right now in the cycle. Regulatory tends to have a forward look. It tends to anticipate what could happen, what might happen. The unexpected loss scenario as opposed to the expected loss scenario comes into that sort of space. Eric mentioned this. IFRS tries to be neutral. It tries to be unbiased. Whereas from a regulatory perspective, prudence is the sort of ruling word. Now we mentioned this, we touched on this a little bit yesterday when we said, well, what is the difference between those two and why do we have those two? And one of the reasons is it's very easy to define unbiased. Unbiased is simply the midpoint. It's the point at which 50% could be worse or 50% could be better. It's very difficult to define prudence. What is prudent? How prudent should you be? How conservative should you be? Now regulators, maybe in that rule book of Eric's, can provide a bank with a lot of specific guidance on how prudent you need to be. So when we talked about the LGD, the downturn LGD, you provide a lot of guidance on the very specifics of how you calculate a downturn LGD. You can do that because you're much closer to a very specific industry with very specific issues. So prudence is a tool that is usable for a regulator, is much more difficult for an accounting standard setter. IFRS has an asset liability focus, so we start from the assets and liabilities and build up from there. As I mentioned yesterday when we were talking about this, equity from an IFRS perspective tends to be the balancing number. It's what's left after you've decided what your assets are and what your liabilities are. From a regulatory perspective, equity is the number. That's the number you start with. And in fact, you use that number to determine how much assets and how much liabilities you can have. So it's completely a reverse in the starting point of where we come from with these. IFRS is also transaction focused, and I think we touched on this a little bit too. We talk about lending arrangements no matter who we're lending to. It doesn't matter. If you are a lending company, you might be BMW Financial Services and have absolutely nothing to do with banking, or you might be a bank and be regulated, or you might be an insurance company that lends and be regulated by an insurance regulator. All we're concerned about is it is a loan, and we want to make sure the loan is treated exactly the same wherever it happens to occur in whatever type of industry it happens to occur. Regulator is much closer to the industry. So a regulator is a banking regulator or an insurance regulator or a financial instrument or a asset management regulator. So that allows you to actually refine the tools you use a lot more than potentially we can. IFRS is also generally principle-based. Now, we had quite a big discussion about this yesterday, the difference between principles and rules. I don't want to revisit the discussion, but I think the important point there was that we tend to be more principle-based, but sometimes lapse into rules. A regulator generally also starts with principles, but has the ability to move more into rules than perhaps in accounting because of the fact that you're much closer to the business and because of the fact that you can be much more reactive. You can change your rules on a more regular basis to reflect what's happening in the market. IFRS also has an issue that it is much, much slower to respond. And it's much slower to respond because we've got this broad swathe of people we have to take into account. We have to consult considerably more, and etc. Now, the last 2 points, the best example of the last 2 points in my mind was the disclosures that came out around Greek debt and where Greek debt got to at a point in time. IASB had a very broad thing that says you should disclose information that is useful to your users of financial statements. And we would hope that that would, as a principle, catch Greek debt. Regulators were able to say, you must disclose information about Greek debt, and this is the information you must disclose. So regulators were able to respond to an event by bringing out a rule that required a particular thing. If IFRS were to have made those changes, it probably would have taken us a year to make those changes. Regulators in particular environments were able to make those changes within a matter of weeks. They were able to respond much quicker. So it talks about the way that we can also play in the same space. Ideally, all that regulators were doing is saying this is how you should interpret IFRS. This is the way you should interpret the requirement to disclose useful information. I'm going to skip that one. The next 4 slides deal with specific elements, as we talk about them, of the financial statements. I'm not going to go into much difference here, or much detail here. Really, when we talk about assets, we start from the same place. We both have a mixed model for valuation. I found interesting Eric's point, and it's one that actually plays quite interesting to a discussion we had yesterday, that on one side of the equation, a lot of people will tell you that fair value is a bad thing to have on financial statements because of the unrealized profit element and how it affects and etc., etc. At the same time, yesterday when we were talking, Philippe mentioned the fact that there was an FT article yesterday in which there's now academic research showed that actually full fair value financial statements for banks are a far better indicator of failure of banks. Now, one might argue, to put together the point that Eric made earlier and that point, that perhaps what happens is the more fair value you have on the financial statements, the more likely you are to fail, because it makes certain things, it makes the ups and the downs more transparent. But certainly it indicates that there's still room for space in this debate of the mixed model, amortized cost versus fair value. Mention neutrality, mention point in time. A couple of the really big differences that come up in assets. Firstly, unexpected losses. So because IFRS is trying to reflect economics, it means expected, yes, unexpected, no. But from a forward-looking perspective, from a prudential perspective, unexpected losses are just as important as expected ones. And a prudential regulator will always take the view, should always take the view, that banks only know what they know, they don't know what they don't know. And that means that you need to be taking into account that additional. Liquidity portfolios is actually an interesting one, because from a liquidity portfolio, we from an IASB perspective would say, well, the intent with a liquidity portfolio is not to sell it. You're holding it to maturity. It's only there for the crisis that might happen, so the unexpected event where you might sell those assets. So we would say amortized cost makes a lot of sense. From a prudential regulator looking at a liquidity portfolio, you would say, well, it is there to be sold when the event happens. So fair value might be very important for you there because you want to know how much it's going to be sold for. You want to know if it can be sold at all. And then recognition, when we recognize assets and liabilities. And we had a little bit of a discussion yesterday about repos and how repos work. So sometimes the recognition between regulators and IFRS might be different. Liabilities, same thing, similar starting point, mixed model. Neutrality comes into play here again. Economic point in time comes into play here again. Again, a few primary distinctions. And as I say, those slides that I talked about in the appendix play out a lot more of these ones. Convertible debt, which is something we talked about yesterday. So we would see convertible debt as a mixture of equity and liability. I think to your point that you asked yesterday, the question you asked yesterday was you said, well, is that conservative? Is that the opposite of conservative? Because what I'm effectively doing is I'm reflecting a liability in my books at a lower amount than what my actual liability is. I'm reflecting a liability in my books at a lower amount than I can actually be called on to repay it at. Okay, and does that make a lot of sense? From an accounting perspective, it makes an awful lot of sense because we assume a going concern. So we assume this thing will flow out over time. And so we're trying to capture in the interest line the higher interest rather than capture in the liability, the higher liability. And those two things do come into conflict to an extent. Recognition, if I've got different recognition principles on assets, they flow into liabilities. And we'll talk about a couple of examples of those later today. And Eric mentioned own credit and the way we each treat own credit. The fact that under IAS 39, own credit, if my credit declines, I show a profit. And that just seems contralogical to everything people think about in this sort of space. Offsetting, when I look at assets and liabilities, is another big distinction. And offsetting effectively comes in because we have very often different offsetting rules. Now, I would perhaps leave this question out there. I know in the olden days, which was 2.5 years ago when I was still working in a bank, at that point in time there was a very significant difference in the offsetting rules for accounting versus regulatory. I'm not sure if that's changed, but what accountants say is you have to have the ability to offset and you have to have the intent to offset. Why? Because what we're thinking about is cash flows. What is the cash flows going to look like on the balance sheet? Regulators are looking at it from a different angle. Regulators would say you just need to have the ability. The intent is not important because what I'm thinking about from a regulatory perspective is the credit risk, the settlement risk that goes with that underlying. And settlement is simply about ability. Can I force net settlement? Yes, then I can offset. So we have a different way of looking at these ones in terms of how we think about it. And probability criteria can often be very different in terms of the way we think about probabilities. The comprehensive income is simply everything that's happened in assets and everything that happened in liabilities flows through to comprehensive income. So this simply reflects what's happening in the other places in the income statement. But equity, and as I said earlier, equity is an important one. It's an important distinction. Equity from the perspective of IFRS is a residual number. So anytime I change my assets, anytime I change my liabilities, it flows into equity. But also importantly, when we look at equity from an IFRS perspective, we simply think of it as one glob, if you want to put it that way. It's simply the difference between that side and that side. When you start thinking about equity from a regulatory perspective, it's something completely different because now what you're thinking about is all the different classes. One of the things that we've left open in IFRS is how you split your equity up. We just don't tell you how to do it. We just leave it completely out there. Don't worry about it. We don't want to. When I was CFO, when I was at First Rand, what we did with our equity, the way we chose to split up our equity, is we split it into shares and the obvious things. But then we took our retained income and we split it up. And we said some of our retained income is monies that under the current Basel restrictions we could never distribute. It was our 1-year EL, for example. It was anything else that we felt was important. So what we did was we gave the users of our financial statements some additional information about our equity. Here's our core equity. Here's our retained income. But our retained income is not available for distribution because the Reserve Bank requires that we keep these and these. What we always thought would be very useful was if our regulator, and we mentioned to the regulator, but I don't think he got around to it at the time, was if our regulator required all banks to do that. because that would allow people using the financial statements to be able to see what the regulatory constraints are on capital, what the additional amounts are for capital. And I think this is something to think about in individual jurisdictions. It doesn't change IFRS, because IFRS says break it up however you like. All you're doing is you're coming along and saying, well, this is how we would like you to break it up. Put these separate categories in there so people can understand when they're using your financial statements what the restrictions on equity are. And it's all about that transparency of understanding the two different views. There are also a couple of other things that really come in. And in this sort of space, the distinction in viewpoint becomes really important. The viewpoint that we're taking, and Eric covered it to a certain extent when he started talking about the way we do different consolidations. We consolidate differently because we're saying the viewpoint is the shareholder. The shareholder owns everything. The shareholder owns the sausage factory, whether they want the sausage factory or not. If I buy shares in a bank and it owns a sausage factory, I own a sausage factory. So when we look at it from the perspective of the shareholder, we want to know about all of those things. The role of a regulator is stability of the banking sector, so the regulator will focus, their viewpoint will focus from the viewpoint, if you like, of the depositor. And that means you only want to consolidate the banks. And that makes absolute sense. But it's a different viewpoint, and it's something we have to bear in mind to understand how our numbers are different. Now, one way to do this would be to put a rule in place that says that you're not allowed to buy sausage factories if you're a bank. But I think we all know that banks like to do private equity businesses, and private equity businesses often own things like sausage factories. I specifically won't forget the fact that on the balance sheet of First Rand for 3 years, we had an item called inventory, and what inventory actually was chickens. Because we had decided to buy a chicken hatchery, or whatever you call a chicken thing. We also had a very substantial item on our balance sheet for wheelie bins. You know, the dustbins that you move around with wheels on? Because we had actually done all the financing for the South African government for their purchase of wheelie bins, and we were leasing those wheelie bins to the South African government. So all these sorts of odd things come onto balance sheets. From a banking perspective, from a bank regulator perspective, a lot of them might be completely irrelevant, and excluding them does make sense. I've mentioned this, I think this was pretty much the perspective. One extra point that I think is important when dealing with perspective, though, is that one thing shareholders don't have is the right to ask for additional information. They don't have the right to go to a bank and say, actually, I want you to disclose something more about something. Regulators generally do have that right. That means that from an accounting perspective, we have to try and cover all the options. We have to put everything in the disclosure that we think people might possibly need, because they never have the right to ask for additional information. Now, the 31 worksheets, was it, Eric? The 31 worksheets in FINRAP scare me a little bit, in the thousands of data points, because in some ways the power that a regulator has is to ask for additional information if something happens. The problem with additional information, though, is there's a delay in getting it, because somebody has to go and figure out how they're going to do it, and you very seldom have a trail to see what's happened with that additional information. But certainly it is a point that regulators can ask for additional information if it's relevant to a particular circumstance. Okay, so in summary, we do have different objectives. But the differences, as much as I've scared you by telling you all these differences, they're actually only on the margin. We would calculate the exact same value for loans. We'd use exactly the same factors for calculating impairments on loans. You might just add an additional factor to bring in a prudential view. But we've started from exactly the same points. We need to work together to reduce the differences. And the discussion that we had yesterday about probability of default and LGD and how we can work those, maybe the right answer there is for us to write a definition that isn't a definition of PD, because PD belongs to Basel, but is a definition that incorporates the Basel definition. So banks can use the same thing or only have limited adjustments. But we need to work to reduce the differences, because the worst thing that can possibly happen for either of us is if banks have to start preparing two sets of financial statements. Because when that happens, accountability goes out the window. I have to prepare one thing for my shareholders, I prepare something completely different for my regulators. Who knows how the two actually reconcile? My shareholders will never quite understand what my regulators are seeing, and my regulators will never understand what my shareholders are seeing. So starting from the same common point, keeping a single set of financial statements is maybe the most important objective. And one of the reasons why we continuously try to speak to Basel, to the guys doing Solvency II, to understand what they're doing, the direction they're going in, and they seek to continually talk to us. And we have that ongoing dialogue that happens between the two. All right. Any questions? And Eric, do you want to perhaps come up here and maybe we answer the questions together if there are any that sort of cover both issues? We've got about 15 minutes, I think, for questions based on the revised timetable. I think I'm Eric and you Darrel. I think I'm Eric and you Darrel.
Well, you know, people pay a lot of money in management trainings to be...
There we go, yeah, absolutely. So I'll answer the regulatory questions and you can answer the IFRS questions.
Kind of unique approach that we...
So I have a question on IFRS 7. So I think thank you for the presentation. I think it was very good as other presentations. So we were discussing the difference. So we said regulation is IFRS plus stress test, but then what you do with IFRS 7. So in your view, how compliant is the practice with what IFRS 7 requires in terms of disclosing material risks? I mean, in Europe or in the US, because we have some disputes with our banks because they say that look what is going on elsewhere. Nobody discloses what you ask to disclose, and then you have the Pillar 3. And you should disclose probably something there, but then the question is why you need, again, as you mentioned, you should have disclosures as short as possible, and you don't want to have similar disclosures everywhere. So again, if it's not compliant, maybe solution is just to get rid of IFRS 7 and say that.
I'll start by perhaps answering it in two different spaces, and then Eric can pick up from there. I think the first point is that IFRS 7 is particularly subject to what we call boilerplate disclosure. And boilerplate disclosure means that what I do is I copy from the biggest bank in my country, I put it in there, and I change a few words in a few places to make it different, but I'm not actually saying anything fresh. I'm not telling anybody anything. And I think this sort of comes to Eric's point about maybe it's more important to focus on tabular, number disclosure, rather than words. And unfortunately, IFRS 7 brings in a lot of word-type disclosure, which is done very badly. We're busy with a project right now at the IFRS to re-look at our disclosure requirements across the board, to try to see if we can eliminate this sort of boilerplate disclosure, this meaningless disclosure that happens. Certainly me, from the perspective of looking at financial statements of my competitor banks, when I was trying to understand what my competitor banks were, I went first to their Pillar 3 disclosure to look at what that was, and then went from there to IFRS 7. I found the Pillar 3 disclosure more useful. Now, the one problem that you do have with Pillar 3, though, and I think Eric touched on this too, is Pillar 3 is for the regulated banks in the group. The company that I was part of, First Rand, we had 1,500 subsidiaries, 14 of them were banks. So my Pillar 3 disclosure covered a very small component of my business, not from a currency value, but certainly from a company perspective. But it's certainly something that we're working at. And if I look now at the credit disclosures that we try to come up with, the new impairment disclosure we're talking about, we started by looking at the Pillar 3 stuff and said, what in here is useful? Let's bring that in.
Well, actually, if I can compliment you, that's exactly what I wanted to say. The nice thing about Bibles is that there are a lot of stories in it. And people read a lot of stories in it too, probably. No, actually, I wanted to reiterate that point. I mean, there's a lot of Pillar 3 disclosure in here. It is in the regulation. Banks must do this. And the own funds disclosure was mentioned, or the equity. I mean, what banks are required to do is to have a detailed reconciliation from the accounting equity number to the prudential regulatory capital number, I mean, including filters and etc. So that is there. Banks must do it, and normally they do it. And on top of this level 1 requirement, the EBA, actually before the end of this year, will develop a uniform reporting template so that banks will use exactly the same format to do this reconciliation. On risk management and risk, I mean, there are a whole kind of series of the different exposure types. You have to give relatively detailed breakdowns of the credit risk into the various exposure type, operational risk, counterparty risk, you name it. Every kind of risk chart which is there you have to disclose. Overall on risk management, and I think that can be a very powerful requirement, banks have to disclose their risk management policies, and on top of that, and I think that's relatively new, that's not necessarily Basel but a European requirement, the bank management, the management body needs to sign a declaration that they have fully understood the risk and the risk management, and that they consider this adequate in relation to the institutional risk profile. So they are on the hook, so to say. And I think, personally, I mean, that's what Sarbanes-Oxley Act did as well in the US, that can be a big driver, because somebody has a moment where he or she has to think, okay, I signed this off, I'm liable for it, is it actually true what I'm signing off? So, I mean, as long as you have, whenever you have to sign with your name and you know you're on the hook, I think people may think twice. So let's hope that that will be a deterrent to excessive risk-taking as well.
May I? Mr. Scott, you have advocated one set of financial information as a realistic option. I'm not so optimistic in this because, for example, there is a huge difference in principle. IFRS use principle of neutrality. Financial statement should be neutral, but regulators like prudentiality. It's something as we would imagine the data, measurement data, as normal distribution. That's what would use the IFRS. When we would apply this prudential principle, this normal distribution would be skewed to the left. That's difference. Concerning this one set of information, because the regulators have objection about recognizing non-realized gains in profit and loss. It could be taken some principles, some usage of for some statements for regulatory purposes only. Some countries do it. That is common. That this measurement differences from evaluation for value for regulatory purposes would be shown as in evaluation reserve, in IFRS, in profit and loss, and it could be then comparable with some notes. This way, parents will use ECB, European Central Bank. The evaluation differences should be in the evaluation reserve, mostly, and then transfer by realizing it, transfer to the profit and loss. And for the Mr. van der Plas, I pronounce it I right, van der Plas. Could you define us or repeat for us precise definition or this in this booklet, loss given default? What does it actually mean? Thank you.
Okay. Well, just for fun, I'm going to answer Mr. Scott's question, and then you can answer. When I talk about a single set of financial statements, I think the important thing I'm talking about is I don't mean an unadjusted set of financial statements. Now, if I pick a couple of the things that you're talking about there, to my mind, I can prepare an entire set of financial statements, and then, for example, unrealized profit and loss. I don't necessarily need to take it out the income statement to achieve the objective you're achieving. What I need to do is I need to say that unrealized profit and loss is either haircut or doesn't go into equity at all. So from an equity calculation, you start with the IFRS equity and you subtract from that the unrealized profit and losses. Likewise, all the other adjustments, and what we sort of envisaged when we talked about this with a couple of other people is that you start with your IFRS financial statements, and then you have very specific adjustments. Adjustments for unrealized profits, adjustments for your capital versus non-capital instruments, instruments that are disqualified for capital or not qualified for capital. Risk weightings for assets to reflect the different degree of risk that occurs in assets. And I think what those are is those are the tools that are available to regulators to take the IFRS numbers and amend those IFRS numbers to reflect the intent that you're doing. I think what concerns me is that if we start from a situation where what that means is that we prepare one set of accounts and then we adjust those for output. The alternative is I start from the beginning and I go this way for the one and that way for the other. And the problem if I start from the beginning and do that, I don't know how to get back from the one to the other. By starting here and going that way, it's very clear to me how I got to there, and then I adjusted it this way. So I think maybe it's an important point. I don't mean that you use your IFRS financial statements as your regulatory numbers, but what you do is you use them as the starting point for determining your regulatory numbers.
I totally agree with that. I think starting with audited IFRS financial statement is a very good starting point. Then you have to eliminate the differences for the scope of consolidation, so forget that. And then basically you apply the filters. But then I have a question to Darrel. I mean, many years ago when I was chairing a small working group that we had on dynamic provisioning, and also a little bit on the realization principle, would it be conceivable, Mr. Wild thinking, huh? Would it be conceivable that the IASB would require a certain disclosure of the unrealized fair value gains or losses and the kind of time horizon in which you expect that to be realized? I mean, if you have a high volume trading book where basically, you know, you sell the instrument 1 week or in the week after the reporting date, then actually by the time that you post financial statements, it has actually been realized. So that all makes sense. But maybe there are some fair value positions there which have a much longer time horizon, month up to a year, etc. And maybe it would give some useful information to users, not only regulators, I think, to have a certain breakdown on the time horizon where.
So I'll answer that question in 2 bits, because I think this is a question that's been raised with us before.
Okay.
And what we've heard in the past from talking to banks was that this was too difficult to do because they don't manage their books like that. That said, from my experience in a bank, in most jurisdictions I've been in, you don't pay tax on unrealized profits.
Exactly.
So every bank I've ever met knows exactly how much their unrealized profits are. So I think it's definitely worth something that's worth bringing back to the table to discuss, because I can't believe that information is not available simply because of this tax issue.
And it could be useful information because the longer the time horizon, I mean, the less you can rely maybe on the point in time valuation of the fair value.
So it's a fair comment.
I have a question to continue on the same topic. You mentioned that the IFRS is a good basis to start for regulators as well, and then the regulators can, let's say, intervene through these adjustments or prudential filters to achieve their objectives. My question is that when these adjustments or prudential filters have an accounting perspective, like for example, loan loss provisioning, from the regulatory perspective, it's an accounting term. So my question is, like, does it make sense to have adjustments or prudential filters that have an accounting nature? To my understanding, accounting should be all on IFRS financial statements. When we go further, it shouldn't be accounting, it's an expectation. That was my topic.
And it's a difficult question, because one of the problems, and Eric touched on it in his presentation, one of the problems you've got is that accounting is not a uniform thing either. There's IFRS, there's national GAAPs, there's some special GAAPs out there, there's US GAAP. So if you start using accounting terms in the regulatory environment, you're at risk of saying, which accounting terms do you mean? And if accounting terms change, you have the same thing. I think it's about just being very, and I guess in that book you get the opportunity to be very definitive about what exactly it is you're trying to achieve with the adjustment. Because that allows you to apply a certain amount of, what would you call it, localization to the adjustments you're making to take account of what exactly it is that you're adjusting and how it was prepared.
Now, I think it is different to, sorry, not different, it's important to differentiate between standardized approaches and IRB approaches. On the standardized approach, basically you take the accounting numbers, that's what you do. When you're on the IRB approach, you have to do your PD, LGD, exposure at default to arrive at the number, and then you compare. So, yes.
So in one you might reverse it out completely, the other one you just make it an add.
Absolutely.
I have a question. You said IFRSs are prepared for users of financial accounts. Users are prudential regulators,
as well,
investors, and all of us. If we have the same starting point, this starting point can go from amortized cost, from fair value, or something else. Obviously, prudential regulators don't trust IFRS's numbers, so they add some prudential filters and so on. We didn't here on the seminar mention rating agencies. Rating agencies represent the investors. Obviously, rating agencies also don't trust IFRSs because you have really good financial numbers in financial statements, and ratings are horrible. So, who, at the end, who does trust the numbers in financial statements? There is always talk about this cost and benefit of IFRSs. If you see IFRSs as a whole, we are only now talking about IFRS 39. Obviously, this is the focal point and the most controversial thing. And the most controversial thing is fair valuing. The colleague said fair value. Okay, you can deduct it from the capital, but I would say you can fair value everything that you want, but you cannot distribute any gains from it to the shareholders. Then you will lose the incentive of the market going up or down, because nobody would have the incentive to trade. So for me, as I see it, everything became too complex, and the added value is very questionable. We have now 2 Bibles, and maybe we'll have 3. I don't know in which God do we have to trust. So
the many religions.
So let me, and I mentioned it when I was up here, as an ex-banker, the word trust is quite a scary word. It's quite a big word. It means quite a lot. I think the important thing is that IFRS is put in place to provide general purpose financial statements. Now, what general purpose financial statements means is it's financial statements for shareholders, it's financial statements for regulators, it's financial statements for the taxman, for the lenders, for suppliers, for anybody, for employees. Anybody who might be interested in those financial statements has the financial statements available for them to use. So what you try to do when you prepare a set of financial statements is you prepare them for, call it the average, for the middle line. You make sure that there's enough information in the disclosure notes so that most people can get the additional information they need if they feel they're going to make adjustments. So when I look at what you're talking about there, what a regulator does, a regulator has very specific requirements, and they are different from the requirements of the other users. My perception of it would be that most regulators in most jurisdictions do trust the IFRS accounts. They just don't always meet their requirements. So they start with the trusted starting point, and then they adjust that for the various additional items they have to adjust for. A credit provider, Standard & Poor's or somebody like that, starts with the financial statements. They trust the financial statements, but they make adjustments to those financial statements for the specific thing they're trying to measure. And very often, out of interest, the Standard & Poor's and the Moody's and those guys, the adjustments they make to the financial statements, other than one for leases, primarily what they're trying to do is get a level playing ground between US GAAP and IFRS. So they want to get the same answer, so they're comparing the same things. A shareholder will also adjust the financial statements. What is a shareholder trying to do? He's worried about the future profits he's likely to earn. So he adjusts the financial statements he's looking now to the future profit. So I think it's probably a fair point that financial statements prepared under IFRS are actually the starting point for everybody, but they're not the final answer for anybody. And the problem with it is if we gave the final answer to one party, by definition, we wouldn't be giving the final answer to everybody else. But it's useful that all these different people have the same starting point.
The starting point should be maybe at cost. So everybody from the cost, you can.
And that's been part of an ongoing discussion that we've had at the board. When is fair value more relevant than amortized cost? When is amortized cost more relevant than fair value? And it's very, very difficult to say that if I go out tomorrow and I buy a swap for $1, that the amortized cost of that swap in 10 years' time when interest rates have gone up and down, that $1 means anything to anybody. It's a meaningless number. So there are cases when fair value makes more sense. Some on this side are absolutely fair value, some are absolutely amortized cost, and some in the middle might be a little bit grey.
If I may add something, well, you mentioned the word trust. I always, when I hear the word trust, I think of a friend of mine who has his own business, who has this nice quote on the wall: "In God we trust, all the others pay cash." And I like that. I think IFRS, its objective is to measure economic performance and the financial position, and that is fair, and I think that's good what they do, and therefore they should allow, I think, personal view, to portray the business model as you do it, and sometimes it means fair value is better, and for some business models amortized cost is better, so I think the mixed measurement model is fit for purpose, probably. Of course, the other way around. Banks and any reporting entity would like to portray its business as good as possible, given the rules. That is the kind of interaction. Yes, they can be the starting point for tax. Yes, they can be the starting point for distribution. But, I mean, taxable income is tax law. And there are all kind of good reasons why they will not accept unrealized losses to be deducted, or why they don't tax unrealized gains. Distribution, the same thing. Distribution is a kind of company law concept, and there, at least in the EU, there's a very restrictive realization principle. Actually, the whole reason historically why we have European company law accounting is for that reason. You have to determine the realized net profit, and that is what you can distribute. I mean, so that's where it is coming from, and I don't think any jurisdiction in the world will use IFRS statements to justify distribution. But maybe Darrel knows more about it. I'm not familiar with South Africa.
Darrel, Eric, thank you very much. I think we need to bring this decision to an end, because we could continue for 2 hours, but then we would never end. So let's take a break. We will come back at 11:30, not to be too late in the program. Thank you very much.